Good afternoon, everybody, and welcome to our latest episode of the Manufacturing Minute, where our goal is to update you on the trends and hot topics shaping the things around the world of manufacturing. I'm Megan Meador. I'm the host of today's podcast, and I am an audit and assurance partner with Brown Edwards. As a reminder, we are a top 100 accounting firm. We are a regional accounting firm with offices in Virginia, West Virginia, and Tennessee. And we offer all types of accounting and consulting services. As always, please visit our website at becpas.com for more information and to view all of the fabulous accounting services that we offer. I am the manufacturing and distribution industry leader for the practice. I'm based out of our Bristol, Tennessee office, but I have clients all over Southwest Virginia, Eastern Tennessee, Kentucky, Southern West Virginia. With all of that said, I'm very excited today to introduce our guest speaker, John Henning, which he told me is like Peyton Manning, but with an H just now. So he's with the Specialty Tax Group. They're a partner with Brown Edwards. We work with them all the time. And today we are going to chat all about cost segregation studies and how they can benefit new and expanding manufacturing businesses. So hi, John. You want to tell us a little bit about yourself?
Yeah, thanks for having me, Megan. That's great.
Yeah, sure.
Without John Hanning, without all the fame and talent and money, I guess, that Peyton has. So yeah, a little bit of background on me. I've done cost segregation for the better part of 20 years. I started in the industry back in 2004, working for a large national CPA firm, delivering wholly on credits and incentives focused really primarily on cost segregation. And now that's morphed along the way with the tangible property regs and the dispositions, and that we've one big beautiful bill giving us a little bit more, a bigger bite at the apple, if you will, with accelerated depreciation deductions. So Specialty Tax Group's a firm that delivers on credits and incentives. We're not everything to everybody. We don't do your tax 1040. We won't do your audit. We do something that's very specific in credits and incentives, and that has a couple of different verticals in it, but we'll be talking about cost seg today.
I'm excited to get started. So tell us all about it. What is the purpose of a cost segregation study and how can it benefit my property?
Yeah, so generally we say that we work with folks that have bricks and sticks or real estate owners, right? Real estate holding companies. And what we're trying to achieve is if you have that asset held out for the production of income, you're using that asset in your business, then you can take an allowable depreciation deduction on it. What cost segregation does is it divvies up the components of that asset over accelerated personal or land improvement lives. So what we're trying to do very simply is accelerate the deductions allowable to the taxpayer versus taking it over the life of the asset, which is either deemed 27 and a half years for residential or 39 years for commercial.
So what types of properties are most suitable for these types of studies?
Well, you can do a cost segregation on any type of property, but the target properties that are most suitable are heavy manufacturing, light manufacturing, anybody that has a big process within that structure itself. Therefore, you can pull out a lot of the personal property, not the machinery and equipment that's making the widgets, but all the power and plumbing that's associated with that process. Those are oftentimes very good targets for us. Not only that, but medical office buildings or apartment complexes. Any type of asset that is subject to cost segregation, but the ones that are built out a little bit more for the process generally have the biggest return on investment.
So I come from a little bit of a background in the coal industry, and we used to segregate assets into mobile and immobile. And so usually when I think about cost seg, I'm thinking about those immobile things, right? The stuff that's kind of stuck to the ground. You're not going to look at mobile things that can move from location to location or be loaded up on a truck or dismantled. You're looking at stuff that's immobile, correct?
Yeah, that's right. So, I like to say if you pick up the building and turn it upside down and shake it, anything that falls out, tables, chairs, uninstalled equipment, that kind of stuff is not really the target of cost segregation. But that's very clearly known by the taxpayer to be personal property. What we're looking at are those installed assets that help support the function of or the process. I like installed. I like the word installed, or you call it mobile or immobile. I like to bring up the White 6-point test. So the White 6-point test is something that is removable and reusable. So oftentimes we're looking at assets that are installed, but deemed to be removable and reusable and accelerated personal property based on the White 6-point test. Wallpaper is removable and reusable. So
That's for another woman, not this woman, right? But yeah, I hear you.
that wouldn't certainly fall over if we picked up the building and turned it over. So there's some complexities here when we're talking about removability and reusability, and then of course, immobile or mobile or those kinds of things.
Well, and we stick to you experts too to help us, separate the two, right? You can clearly define under the laws and regulations also and help businesses be able to define what's permanent and what's not, correct?
Yeah, that's exactly right. So, ultimately what we deliver on is an audit ready deliverable. We come in and we're not CPAs, we're generally engineers, we're construction folks that understand, the bricks and sticks that are there, how it's constructed and how it works together with, what type of activity is occurring in that building, and then using, like you said, that case law to support our findings.
So at what stage of property ownership should a cost segregation study be conducted?
Yeah, so I generally say, in the building's transaction year. So whether the building came out of the ground and it was brand new and it's getting ready to be placed on the tax depreciation schedule, or if you purchased it and, in that same year, do a cost seg. That gives you this time value of money concept gives you enough time to recover, any fees associated with doing the study. You can go, however, if you don't, let's say we don't need deductions. We're not making any money. So we don't need accelerated deductions. And so you wait a couple of years. That's not a problem. You can still do a cost segregation on an asset that was placed in service in a previous year. And in fact, you can go all the way back to 1987 to do a cost seg. Um, but would you? That's the next question, right? And the answer is no, because again, you've lost now a lot of that time in that time value money concept calculation. So I generally like to say do it in the year of acquisition or construction. If you don't, then you just have to do an accounting method change in a future year to implement the results of a cost seg in a later year.
So, John, you and I have a mutual client located here in Southwest Virginia, and I believe you just recently completed a cost seg for them. And the situation was that they had been renting that space and had been in that space for multiple years, right? And then they decided to actually purchase it from the previous owner. And so that triggered we kind of kept giving them the elbow nudge. Hey, it might be worth it to do a cost segregation study. And I do believe they were very happy with the outcome of that and were able to save some real dollars with that and an R&D study that they had performed as well.
Yeah, so they had been a tenant for a long time, and you just got to make sure that you're splitting out the assets, what was acquired, what was already there, and what was owned by the operating entity. Just making sure that you understand that. But this is a cash flow tool, right?
Absolutely.
So if they're making a lot of money, and they could use the deductions, I call it in air quotes sometimes an income problem. Their tax liability is pretty high. What we're trying to do is accelerate depreciation deductions to drive down that tax liability so they can keep more money in their pockets, right? So if they just had a big transaction, just bought a big building, maybe their future renovations that are, in the back of their head, but they don't have the cash, this is a good way to put that cash in their hands.
Absolutely. So let's talk a little bit about the nuts and bolts of the process. And how do you determine the classification of assets between personal property, land improvements, and real property?
Great question, and I oftentimes don't get that question, so I appreciate you following up. So publication 946 is the depreciation Bible, if you will, and within there are two tables, tables B1 and B2. Now, tables B1 is on the asset itself, so it's a clearly defined asset. And I'll give you an example. If we have anything supporting a computer, or information systems, that's asset class 0012 and recovered over 5 years. So that's specific to an asset. Now, they haven't listed, as you can imagine, every asset in the world, right? In tables B1. Actually, tables B1 is only one page. Then you have 9 pages of table B2. It's assets used in the activity of a certain process. So you could have wallpaper used in the activity of, manufacturing locomotives. A lot of this centers around manufacturing allied chemicals and dyes and food processing and all that stuff. So you look to the activity that the taxpayer is within, and then you find out which activity best fits to then be able to define what the GDS recovery period is for each one of those accelerated personal property items.
So are those the methodologies and the guidelines that you follow during the study? Are those the regulations that you typically rely on?
So those are the tools. So publication 946 is certainly what we rely on. Those are the tools, but the methodology is there's six approved methodologies within the ATG, the Audit Techniques Guide. Really, what we're following is the Audit Techniques Guide to deliver on the expectations that the IRS would want to see, what they believe a quality study to be. And so we follow along the ATG methodology. If you acquired something, we have a different set of requests. Of course, you might not have blueprints and or cost on what was built, but you have a closing statement and perhaps a property condition report or an appraisal. That we're using cost estimates to recreate the assets that are there using nationally recognized costing models, means, Marshall and Swift, and those kinds of things. However, if you built the building, then of course you did have the drawings and most likely do have a good cost detail. In the methodology there is, doing a full engineering study with actual cost records. So it just depends on, what methodology we use based on, what the approach is.
So you go through the study and you identify all these separate asset classes, if you will. So what does that mean, right? So what kind of report comes out of that, and what does that mean for me on down the line with depreciation schedules?
Right. So I often tell my wife I'm not the coolest kid at the party because I'm a federal tax depreciation specialist. But the detail created, in that final report is it's truly exciting and it really is helpful to not only the taxpayer who's accelerating depreciation deductions, but certainly to their CPA, right? And let me give you a few examples. So when we deliver on a final report, let's say it's going to be 100 pages, we'll deliver not only a methodology, our facts and findings, but then very and highly detailed cost information for each one of the different assets. And we'll tell the taxpayer what asset class each one of those falls into. We'll also see if bonus applies or not and label that as well. So it's this full audit ready deliverable that allows the taxpayer to be very comfortable in the positions taken, as well as the CPA, knowing that they had somebody that knows this kind of stuff and has delivered, and we're not sticking our necks out there. We're doing it right. We're staying away from that red line, if you will, and we're taking allowable dispositions or deductions where they're allowable to us.
So speaking of kind of audit readiness and the things that are being prepared, what kind of documentation or records do you require? Say I'm a controller out there and I'm hearing this wonderful podcast about all these things that could possibly save me some real tax dollars. What do I need to do to be prepared? What kind of documentation would your group or somebody like your group be looking for us to have?
So when it comes to an acquisition, we're going to collect as much detail as we can, and it doesn't preclude us from doing the project if you don't have these list of items. But we'll ask as a part of our due diligence process. Property condition report, Alta surveys. Is there an appraisal available? Certainly, the closing statement if it was an acquisition. Separately, if it was a newly constructed asset, the AIA, General Contractors 703 or 702. This is the detail by trade. What did you spend on plumbing? What did you spend on electrical? Those kinds of things. Then a GL, the general ledger with capitalized cost information, anything that was paid for outside of the general contractor's scope of work. Um, of course, the plans, if available, as builds are best. We're going to collect all that information to do our study. It seems like a lot of information. So when that controller says, "Man, I don't have another minute to take on another project," we walk them through every bit of this. And in fact, we do a site visit with everything project that we do. If ATG says that a quality study always includes a site visit, we want to be there looking to see how things are used in the business, what's the manner of attachment, those kinds of things. And so generally, we collect some of that information and walk them through that process. So they're not, just kind of hunting and pecking and sending everything in the kitchen sink to us. We really kind of sit them down and say, okay, even in a 30-minute conversation, we can get everything we need to move forward.
So, how long does that process typically take?
So I say between 30 and 60 days. But if we have a really, really good client that's really engaging in the process, and in fact we can have good access to the building itself, that can be shortened quite a bit. So we have a great team here at Specialty Tax Group. Most of the folks that are working here have been working here 5+ years, and they know the process and they can get things done pretty quickly. We've developed internal use software that kind of helps us through the process a little bit more efficiently too. So if you come to me at the taxpayers, always are scrambling right at the end, or I get that late. We're right up against 10/15 extended filing tax deadline. I got a couple calls last week and said, "Hey, I didn't realize. However, couldn't you help us out?" We were able to turn things around pretty quickly. So I'm proud of our team. And if we don't want the client to be in that position, it's not a great experience for everybody, but we can certainly turn it around pretty quick.
And then at the end of the study, what kind of deliverable is handed to that controller or that company after you're done?
So two things. So we'll give that audit ready PDF deliverable that's about 100 pages explaining the methodology and of course how we got to all the numbers, and then an Excel file with all units of property that have been split out and accelerated. That is formatted to be an easy upload to the depreciation schedule and or most fixed asset softwares. That's another benefit of our deliverables, is that instead of sending somebody a list and having them key into the fixed asset software, they can just hit the upload button. It eliminates any keying errors or anything like that.
We all love that. We all love an easy upload.
That's right.
So, John, I mean, we all look at the news, right? We're all looking around at what's going on in our economy, and there's lots of attraction right now to build manufacturing and other businesses, but specifically in manufacturing to domestic locations, right? So, I'm in Southwest Virginia. Every
Mhm.
conference, every news article, every news blast I get from the Virginia VDP, all of that is just talking about expansion and bringing companies back into the U.S. And so, stuff like this it's an easy process that could have some true cash tax savings for a lot of folks. And I think that the benefits of doing the study are tremendous. I love it when people are asking questions early. I love it when we have those interactive discussions with our clients to give them the opportunity. I mean, we're accountants, right? We're CPAs. We follow the rules. But it's our job to provide tax savings and tax planning to people. So, I did another podcast on R&D studies and just proactive communication with your CPA to be able to identify these types of opportunities is just priceless. To be able to, as a site controller with maybe an overseas ownership type of a situation, or maybe private equity or something like that, to be able to identify just these situations where a study may or may not benefit, I think is, really priceless and a great opportunity for new and expanding businesses locally.
Yeah, I couldn't agree more. Like you said, there's so much activity in the space, and there's a lot of energy about talking about it. And then, of course, the one big beautiful tax bill incentivized, all those taxpayers quite a bit to re-onshore those manufacturing jobs. So a lot of buildings going up to support that. It's a pretty exciting time for us.
Very exciting. So how much tax savings can have you seen in the past from these types of studies?
It depends. It depends on the basis and how much they spent. Obviously they spent $10 million on a manufacturing facility. That's going to yield a lower accelerated deductions than if they spent 100 million, right? But if you think about it, with 100% bonus at play for 2025, permanently beyond 2025, folks that placed in service, assets, we're seeing between 20 and 25% of the basis amount being accelerated in the first year, which is pretty significant, if you're talking about a, $10 million build, right? So that goes a long way in kind of helping to eliminate income.
That goes a very long way. Are there any, so I've heard nothing but good here, right? What are the downfalls? What are our risks associated with doing something like this?
Yeah, so sometimes I'll get a call from, I talked about a biotech company that called me not too long ago and said, "Hey, John, we just built a brand new facility, and obviously we need a cost segregation." And I said, this I'm going to be able to offset your income quite a bit. They said, "Well, we don't have any income." And I said, "Well, then don't do a study." So, just kind of knowing and having a true consultant on your side, as much as we like to qualify a study, we disqualify studies all the time. So if you're not making any income, don't do an accelerated depreciation study, right? There's nothing there to offset. Also, if you're gonna not hold the property for very long, this being a time value of money concept, you need some time. And if you're gonna hold the property for a year, it's probably not the right tax strategy. So we talk through all of this with clients. If you're gonna hold it between 3 and 5 years, let's say, that puts you beyond any damage from recapture. You could have taken too much depreciation at the onset, but then you pretty much sold it right away. There could be some recapture that isn't going to be kind in that sale. So just understand the pitfalls are not truly understanding what you're trying to accomplish here. Working in concert with your CPA to make certain that this is the right tax strategy for that taxpayer. That's my word of caution for everybody listening and saying accelerated deductions, increased cash flow. Let me go forward. I just understand what you're getting into.
So we talked a little bit earlier though, right, about how maybe I'm in a loss position today, but 5 years from today, I'm in an income position. I can go back and claw that back, right, though, and do a study at that time and decide if it's a beneficial activity for to do at that time.
Yep, you're exactly right. We have many taxpayers that do that. Folks that are in startup mode are putting all the every dollar they have back into the business. There's not much, it's not dropping a lot of cash, but in a couple of years, that becomes an opportunity to do a cost segregation. And that change in accounting method, you don't amend any returns. You just, in the year of change, you catch up all the missed depreciation in that year of change. So it's pretty impactful when they do decide to do it.
So, how will the results of this study impact my financial statements and my tax filings overall?
Well, so you're accelerating depreciation deductions in year one, so obviously that's going to lower your tax liability and create more cash flow. So that's a significant portion of it. In the future years, you're going to have lowered your net tax value, right, or net book value. So we're not creating any additional deductions. We're just front loading the deductions allowable to the taxpayer. So if you take it all today, you get a little less tomorrow, kind of thing. And so that net tax value is a little bit lower in future years.
We really appreciate your time today, John. I mean, these are important decisions that current and future developers need to understand. I mean, the credits and the benefits are out there for us to take, right? To take full advantage of. And so it's just knowing that they're available, knowing the right people to talk to, knowing the processes to take to, hopefully have a good outcome. I love it if I can find a client some good cost savings, cash savings, and then they can take that and put it somewhere else, whether that's investing in AI or possibly, hiring a position or two or three or four or five,
Yeah,
taking advantage of that cash savings. Cash is king, right? And so anything we can do to help. So we really appreciate your time today and talking us through cost segregation studies.
absolutely. Thanks for having me, Megan.
Absolutely. Thanks, John.